The start of the new financial year kicks off next week, and with it comes a few changes to superannuation. These changes are pretty positive, and they're mostly going to impact people between the ages of 67 and 74. But there's a couple of little things in there for the younger generation as well. And so today I want to step you through each change in a simple to understand approach so you can decide for yourself whether or not it impacts your personal financial plan. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about the changes coming to superannuation on 1 July 2022. This one affects all employees and business owners with employees. The SG rate is increasing from 10% to 10.5% on 1 July 2022. This is a continuation of the plan to get the SG rate to 12% by 1 July 2025. So does this mean that as an employee, you essentially get a 0.5% pay rise? Well, potentially, but not necessarily. While employers are obligated to increase your superannuation contributions by 0.5%, they're not obligated to do that in addition to what you're currently receiving. They can reduce your income to account for the extra 0.5% that's going to go into superannuation. Now, if you have an existing salary sacrifice arrangement or if you're making personal deductible contributions into your superannuation, now is a really good time to review those arrangements to make sure that with the increase in the employer contributions, you're still working within your cap limits. Under the current rules, if you're aged over 67 but below 75, you may contribute to your super if you meet a work test. That is, if you've been gainfully employed for 40 hours or more in any 30-day period in a financial year. From 1 July 2022, this has been abolished for non-concessional contributions and salary sacrifice contributions. This is a positive move because it gives older Australians more flexibility around how they can use their super. So for example, maybe you can use the eligible spouse contribution for a few extra years. Or maybe you can sell a business at a later date and still have access to the small business CGT cap. The downside is that the work test is still going to apply to personal deductible contributions. So that is voluntary contributions that you make into your superannuation fund that you want to claim a tax deduction for. The Brinfold rule applies to non-concessional contributions and allows you to bring forward up to 2 years of your annual cap from future years. Given the current non-concessional cap limit of 110,000, this means you could potentially contribute up to 330,000 in a single financial year. Currently, the Brinfold rule is only available to people up to the age of 67. However, from 1 July 2022, this is changing and individuals aged between 67 and 74 will be able to utilize the Brinfold provision. Given the work test was also scrapped on non-concessional contributions for this age range, it really does give you a lot more flexibility around using your super, which leads to more potential strategies. For example, maybe you have adult children that you want to gift your superannuation to, and in order to avoid some of the tax payable on a death benefit to an adult child, you can look at doing a recontribution strategy. Or maybe you simply just want to get more money, more assets into superannuation where it can be held in a tax-free pension account. However, just remember that in order to be eligible to make a non-concessional contribution to your super, your fund balance at the end of the previous financial year still needs to be below the transfer balance cap. And at the moment, the transfer balance cap is 1.7 million. The downsizer contribution allows eligible people to contribute up to 300,000 of the proceeds from the sale of their home to superannuation, and it doesn't form part of any contributions cap limit. In addition, you can make the contribution even if your super balance exceeds the transfer balance cap. To be eligible, you need to sell a property that you've owned for at least 10 years and lived in as your main residence at some point. The contribution must be made within 90 days of the sale of the property, and you have to meet a minimum age requirement. That age requirement was previously 65, but come 1 July 2022, the age requirement is dropping to age 60. In the latest federal election, the Liberal Party did actually say that they would reduce the downsizer contribution age further to age 55. and Labor quickly said that they would match this policy, so that could potentially be in the pipeline, but it hasn't been legislated as yet. If you have an account-based pension or a transition to retirement pension, then there is a minimum amount that you need to draw down from that account each year, and it increases with age. When COVID hit back in 2020, the government temporarily halved the minimum you need to withdraw in order to help people protect their retirement nest egg while the stock market was down. The halving of the minimum is going to continue in the 2022-23 financial year, which is a good thing because let's face it, it's been a pretty tough start to the year for investments. So all of these changes need to be factored into your retirement plan where applicable. And if you think one of them is relevant to you and your situation, then either do some further digging on it or reach out and get some professional advice, because it's not the kind of thing that you really want to get wrong. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up and I will see you guys in the next one.